Good evening, everyone. This is Triple Tech Group third quarter 2023 analyst briefing. This is Peter. So as Rohit, the group CEO, and a couple members from the senior management team will go through the presentation. Please keep your line muted during the presentation. After the presentation, we're going to move on to Q&A. And so with that, I'm going to bring Rohit up for his presentation.
Good. Okay. Thank you, everyone. Moving on, so I'm happy to be with you again. This is third quarter results. We'll continue our usual update. So we're nearing the end of the commitments we made to all of you and the market in general. We had made 8 commitments in our journey of transforming this business towards much bigger things. And as you can see from the dashboard, we are green on 7 of them, we're at risk on 1 of them, and I'll delve deeper into each of them. From a travel, from an overall retention perspective, we continue to improve our retention. Every quarter, you've seen that. Today, our retention is at 76% YTD. For this quarter, it's at 74%, so it's obviously well above the required levels. We have made full exit from low retention, large corporate commercial accounts. The remaining accounts in the books are higher retention corporate file. That's why you see its retention also slightly increased. And there's also a little bit of renewal book still to run off, but there's no new business there. At NWP level, it's the first quarter where we have small impact of Penang. Last year, same quarter. But as you can see, our NWP has grown with Penang 21.8% and without Penang 42.4%, which is a very strong growth rate. Our third quarter NWP is up 22% year on year. This is with Penang. And our 9-month is catching up despite the gaps we have on Penang. Our health growth is led by foreign worker segment. We are seeing good growth of foreign worker segment across our different markets. Our lifestyle pillar is grown by motor and travel. SME has fell marginally because that's some normal quarterly adjustments that you would see in an insurance company. Overall, you will see that our net written premium contribution from digital partnerships and e-commerce has grown this year, and it's grown this quarter in particular. Without Penang, it's growing quite a bit. The top 5 partners contribute about 51% of the total premiums now. We welcome 2 new partners in the quarter. In Malaysia, we're the first insurer working with CGC, Credit Guarantee Corporation, to introduce digitalized insurance for MSMEs. And in Thailand, we are bundling our travel insurance for True SIM card. So next time you travel to Thailand, when you arrive at the airport and you decide to buy a SIM card, you will get a True Protect insurance. And we continue to work very hard to penetrate our existing insurance space. We're quite aggressive in putting our brand out there and making more people aware. This is just a quick summary of all the various campaigns we are running, partnering different people, but also on our own. And we've been getting some rewards for it and so on and so forth as well. I will hand over to Jubin to talk about CGC.
Thanks, Rohit. So as you know, we made our foray into the SME space in the last 1 year, and we launched Tune Protect Life, which was a life plan targeted towards SME, and we launched a microsite in the second quarter this year. Our collaboration with CGC is the first of its kind. It's one of our large partners now, where we are promoting our SME plans on their digital platform, which is called IM SME. It's a self-service customer portal where a lot of their SMEs go and apply for loans. CGC, as you know, is the largest provider of guarantee cover and trade financing to micro and small SMEs in Malaysia, and they work with almost all the large banks. We're the first insurer to go online with them. The 3 products that we are live with is SME Business Shield, SME Easy, and PA Easy plans. Slide, please. We're also proud to announce that with AirAsia, we've gone cashless. So now our insurance plans come bundled with a cashless cashless facility for our customers. This is part of our plan to enhance our customer and claims experience for our AirAsia travel customers. This plan will provide access to 5,000 hospitals worldwide, and we collaborate with Europe Assistance for this. This will also enhance the claims journey that we have with the customers. And eventually, we aim to increase our take-up rate on customers who buy flights from AirAsia. Will eventually end up buying more insurance because the customer experience journey will be more enhanced now with this product feature.
And we just had a meeting with AirAsia just before this, and I think just this plan has seen an impact in October of about 1% increase in take-up rate, and particularly on the more higher-end plans. Okay. So moving on, how do you want to talk to the combined ratio?
Okay, hi, thanks. For those that actually attended our MFRS 17's briefing last month, I think you will probably be more familiar with these new MFRS 17's KPIs or measures that we shared during the sessions. So I'm happy to report that basically our combined ratio 3Q 2023 actually improved from 100.5 to 95.2. And previously, I think what you're more used to, the NCI claims ratio, has now basically been replaced with net incurred claims and attributable expenses ratio. That you will notice that basically is fairly, I think, stagnant at 37.9. I think slightly improved to 37.3%. That's actually at the backing of improved claim experience that we are seeing from motor, PA, as well as travel segments. However, this improvement in our actual claims experience has actually partially been offset because of during the quarter of 3Q 23, we actually recorded a lower insurance revenue. And as you know, insurance revenue now represent gross earned premium or akin gross earned premium. So with a higher actually motor book last year, our insurance revenue was a bit higher. When we are actually having a lower insurance revenue this quarter, what it will also mean is that it will actually indirectly push up all the ratio. However, I think we still managed to actually maintain our NCI ratio with slight improvement to 37.3. That was at the backing of a significant improvement in our claim experience despite the lower insurance revenue. I will actually be taking some of these questions. I think if you guys have any of those questions, I think later part, so that we know that basically you guys truly understand, I think, where we're coming from. And the next ratio that we actually also shared during the session before was our acquisition cost ratio. Our acquisition cost ratio had gone up, I think, from 24.7 to 36.1%. The increase in acquisition costs, I think, were mainly due to, I think, two prongs, I think, impact. One was when we are having a lower insurance revenue in 3Q23, it will first, I think, push up our ratio on acquisition costs. And also in 3Q23, we do actually record a higher marketing spend during the quarter in promoting our branding activities. Corresponding period last year of 2022, that actually came in quarter 4. So there was a slight timing difference in when this marketing spend was actually recorded in 2022, which happened in Q4 2022. Whereas in 2023, it actually came in earlier, I think in Q3. Both of these factors basically explain for why our acquisition cost ratio basically have gone up by 11.4. Despite this, I think just now I explained twice that with the lower insurance revenue. So with lower insurance revenue, basically what happened was we actually exit from the commercial book, as what Rohit presented just now. With the exit of commercial book, our retention ratio basically have gone up. And that will also means that our reinsurance cost or reinsurance ratio basically has now be much lower than before. At 2Q 2022, our reinsurance cost basically make up approximately 37.9% of our total cost of doing business. Now, with higher retention and the exit from commercial book, the reinsurance cost or reinsurance ratio have now declined to 21.8. So collectively, with these three movement in the ratio, collectively our combined ratio has really improved by about 5.3%. And year-to-date combined ratio improved from 98.5% to 95.3%, approximately an improvement of 3.2 percentage point. Next slide.
Okay, thanks, sir. So on the tech side, we did say we will have more paying clients. There is a risk on this one because some of those conversations are going longer than we expected it to. However, obviously, tech continues to innovate, continue to disrupt. You will see that our volumes have gone up without Penang quite a bit, and the tech is able to handle it. We are progressing soon on replacing the backbone of our company, which I've mentioned a few times. We're replacing our core system with SAP. We are having more new faces coming. By the middle of next year, this project should have been implemented and then move into what we call maintenance phase. So we've gone live with phase 2B, and we're continuing to push hard as we speak. Vietnam is fast becoming a major contributor to our top line after Malaysia and Thailand, and you are seeing that as well. And of course, Middle East. Vietjet is starting to pick up because our first quarter, and obviously we had some natural hiccups when you go live. It's only normal, but it's starting to pick up. It's already 15% of GWP in Vietnam, and we expect that to go up significantly. Obviously, we issued about 81,000 policies. We are bundling insurance, and we extended it for first quarter. Vietnam is activated. We are working hard to activate Indonesia as we speak. And there is a plan agreed with Vietjet on activation as to what will be prioritized in first quarter and then second quarter and so on and so forth. Vietnam business for third quarter has increased 10x. More importantly, 9 months, we're seeing a 1.8x growth. And I think I had mentioned this during my analyst briefings to watch out for Vietnam. Obviously, at that time, I knew that we were in active discussions with Vietjet. We hadn't yet won the deal. So obviously, that's helping us along with the other businesses we are doing. Okay, I'll push it back to Jubin to talk about Pump and Mobile first.
Thanks, Robert. So we've seen some encouraging registration happening from Pump, as well as finally some sales conversion happening with Pump as well. If you recall, we had launched Pump early this year. It's our health tech, which is integrated into the app. It gives you, it connects with your wearable devices, and basically it promotes and incentivizes our customers to stay healthy and fit. Our mobile app downloads have significantly increased. As of third quarter, total downloads stand at around 38,000 customers roughly. Our Pump registered users have also significantly increased in the 3 quarters, from 4,000 to about 13,000. And a lot of these customers are heavily engaged onto the app. So this is sort of like our engagement tool on the app. A lot of the customers who also registered for Pump, we've seen them buying policies from us. So if you see the sales conversion metric below that, it shows that 9.3% of our customers who downloaded Pump, registered for it, actually bought a policy after that. Pump has been a success because we've worked on an omni-channel approach, and there are more than 20 offline events that we've done in a year, where we've associated with triathlons, with marathons, with a lot of these sporting events around the country in Malaysia and Thailand. We've also enhanced our mobile app experience. We built a new UI UX, which got launched in the third quarter, a simplified registration and login page. We've added a lot of features into the app. We added new products into the app. So what I'm going to show you next is unveil our new app. I think back to Peter. He's going to share with you what our new app looks like. as you can see, I think it's a lot of changes on the app. We are also happy to announce that the pump rewards that you now earn on the app can actually very soon be burned on the AirAsia platform. So you'll be able to redeem it against flights and other vouchers as well, which we are going live with very soon. Moving on, if you recall, we had a 333 commitment to the market and also to be an NPS leader in our preferred market. Our latest initiatives around this, we've gone cashless across all our branches and all our locations. A customer can walk in and opt for the cashless payment option. We've removed cash from our branches. So today the options that are available are bank transfers, QR codes, e-wallets, you name it. We have all those options available. We've also launched new touch points. So we started with the CNPS, which is our customer NPS scores, and started measuring that. We've now moved on to transaction NPS surveys, which means that every time a customer buys through us online or registers a claim with us, we do a survey and we try and understand how satisfied the customer has been. And we are tracking these scores very, very closely. Happy to announce that we are also been rated as one of the top 5 general insurers for the customer satisfaction. This was a survey that was run by Bank Nagara in commissioned by PIAM and along with AC Nielsen, who ran the survey. So we are there in the top 5. We've been shortlisted for the CX Asia Excellence Award and categorized for the Best Customer Experience Award in that as well. So overall, our NPS scores have been very, very positive. We move on to the next slide. It will show you where the scores are. We have been a leader in the customer NPS. So as you recall, we've been measuring ourselves against the industry average. Our latest scores, happy to say we are at 43 plus 43, which is higher than the global industry average as well as some of the peers that we measure ourselves. Transaction NPS, because we just started measuring them this year, we have the first quarter baseline. Our claim scores have been higher. Our purchase journey, we don't have the Q3 scores, but second quarter, it's been quite high as well. This is something that we will continue to measure on a regular basis moving forward. Our partner NPS scores have also been at plus 62. So they've stayed steady where they are. As you said, as you recall, we always make a commitment to the market to be the fastest to deal with our partners, the fastest to go live with APIs. And our partners really love us for that. Our customer satisfaction scores have also been steady and high. Again, I think this is something that we will continue to disclose to the market on where we are on these scores on a quarterly basis.
In terms of the customer tracking, which is quite important, yes, we've seen a fall-off due to Penang policies. But if you take the 800,000 Penang policies off, you should see that quarter on quarter, our growth rate is pretty strong. Our average active policy per customer is increasing. Our average product per customer is increasing. Even our unique customer count is increasing without Penang. Customers staying longer, and the average premium also saw a little bit of an increase, but this one, as I told you, it will be within a range. So I repeat what I said last time, don't get excited about it increasing. Don't get equally excited about it reducing. It will be within a range of plus to minus 10%. But I think the other matrices clearly are showing a very, very strong movement, as you can see. And that bodes very well for the organization in terms of what we are building together. Employee NPS continues to be very strong. Our employees are happier with us. We're making the organization much younger. We are in many different events, and we continue to be seen as a thought leader when it comes to insurance, digital insurance, disruption, technology, etc. ESG commitments remain on track. We've achieved zero coal target in our underwriting portfolio in August 23, 7 years ahead of our commitment. So that's quite an interesting one. We're continuing to contribute in terms of CSR hours, in terms of customer paid premiums as well. The only one there that we feel we won't be hitting this year is women in leadership. But the trend still continues of continue to have more women. I'm going to hand over to Yusuf to talk a little bit about some things you should expect as analysts and investors come next year because there are some regulatory changes that are happening?
Thank you, Rohit. So for the coming year, we are expecting to incur between 3.5 to 5 million ringgit to keep abreast of regulatory requirements. Central among these are the e-invoicing requirements, which our Malaysian business, Twin Protect Malaysia, will need to comply by August 2024. Currently, we are also, to complement our digital ambition, we are also investing further in our IT security capabilities in line with Bank Negara Malaysia's risk management and technology requirements. We will also be engaging consultants for climate scenario analysis as part of the expectations under Bank Negara Malaysia's Climate Risk Management and Scenario Analysis Policy Document, which was issued in November 2022, and it is also in line with our ESG commitments as well. So we do expect to incur between 2.5 to 5 million over the next year. Thank you.
And it's a mix of capex and OPEX.
CapEx, it's a mix of capex and OPEX, correct? Yeah.
So just to probably I made a mistake. I didn't introduce you to Yusuf. Yusuf is our Chief Risk and Compliance Officer. Okay, I will hand over to you, How, to talk about the numbers.
Okay, thanks, Rohit. So maybe I just continue here. I think following the ratio that was shared just now. From on this page, what you can see, these numbers are generally what you can also derive actually from our Bursa report. It was also disclosed the same thing in our Bursa report. From the first line, I think as you can see, insurance revenue line, you notice 3Q22 to 3Q23, you notice there's a decline of 15.3%. However, if you were to read this thing in conjunction with maybe the fourth row, allocation of reinsurance premium, you will also notice that actually our reinsurance premiums, our outwards premium basically have declined at a much larger extent. So generally, that means is that what that means is that there's actually an increase instead of the reductions in insurance revenue. There's actually increase in our net insurance revenue if we would like to net it off against the reinsurance premium. So that was pretty much because of the impact from the decisions to gradually exit from our commercial book since 2022. So as a result of that, I think you notice probably if net insurance revenue actually have increased from 71 million to over 81 million. And hence, if you bring to my second point, the net incurred claims and attributable expenses, a reduction from 47.8 million to 39.9, that is actually representing quite a remarkable improvement in our net claims experience, especially from motor, PA, and travel segments, as mentioned earlier on. Despite the increase in our net insurance revenue, our NCI and attributable expenses actually has declined relative to that. So despite that, ratio-wise, it appeared to be similar, but in reality, that is the main factors that actually contributed to the improved combined ratio from our 3Q22 100.5% to 95.2 was mainly attributable to this better claim experience, I think, from the three segments. Amortization of insurance acquisition cash flow, basically that represents our acquisition cost, which now means commission plus other acquisition costs. You will notice there's an increase. I think the increase was actually from 31 million to 38 million was partially aligned with the increase in our net insurance revenue. And then also partially was a result actually of higher, I think, branding spend that actually take place in 3Q23. As I mentioned just now, in 2022, the corresponding branding activities actually only started to take place in Q4. So after combined ratio, you will also notice that our investment income actually moved from a loss of 1.1 to a positive 6.8. I think that was actually pretty much aligned with our better investment performance due to a very prudent portfolio mix that we have adopted, which we have increased our money market funds weightage. And this is actually already the fourth consecutive quarters where we actually recorded a positive return or profitable return, I think, in investments. Yeah. If we would move on to the next slide, I think you will okay, this basically just continue what was sharing just now. I think from the pie chart here, I think you will notice that basically there isn't much movement between our split between unit trust, deposit, and debt security. However, I think in the composition of our unit trust funds, we now actually have basically 74% actually of our money market funds, unit trust funds, actually are allocated to money market funds. So, which actually provide actually a much more stable return and less, I think, exposure to market volatility. So I think, for example, I think the reason again volatility that was experienced in the fixed income market, actually it wasn't really impacting us as much. I think mainly because of these new asset allocations that we have adopted. I think since the Q4 last year. Okay, must
Shall
pass
I
back
take
to you,
it?
Rohit.
Yeah.
Yeah.
Thank you.
Yeah.
So overall, I think this is a slide we always give you. You can see that we continue to be the only one making profits among listed insurtechs who have price over book significantly higher than us. And we continue to, drive customer adoption as well. And this is something we will do. In summary, I think I would like to leave you with 2 or 3 thoughts. One is we grew 40% without a one-off government scheme that we had last year. We are growing in the right segments. Motor is profitable in several segments, like motorcycle is very profitable. We are increasing the percentage of motorcycle we have. We are growing in travel, and we are growing in newer segments like device protection, for example. We are launching a lot of innovative schemes, like, for example, with one of the large bus companies which travel between Singapore, Malaysia, and Singapore. We sell PA with every ticket you buy. And again, that's 150,000 policies on an average that we get every month. Small ticket, but you get it. So these are the kind of innovations we are doing. We continue to evolve on our cloud. We continue to push hard. And as we mentioned always, that once the core project is over, some of the large expense items also will be out of our books from that perspective, although you have maintenance costs. Overall, we're pushing hard, working hard, and obviously as the travel season picks up, we hope to benefit from it.